Hello and welcome, everyone. Thank you so much for joining us for this month's State of Freight. My name is Julia Becker. I'm the Vice President of Media Operations here at FreightWaves. As always, I am joined in studio by our CEO, Craig Fuller, and Sonar's Head of Freight Market Intelligence, Zach Strickland. Today's conversation will cover the latest insights from Sonar, current market trends, and insights from our experts. Craig and Zach will also take your questions at the end of our discussion today, so remember to send those in as you think of them. But before we get started, I want to cover just a couple of quick items. If you've got any issues during the webinar, you can reach out to me via that audience chat function in your webinar console. And again, if you have questions for Craig and Zach, be sure to enter those in that Q&A box. We'll save time at the end for as many questions as time allows. I'll also send a link to the recording of this webinar tomorrow in case you want to watch it on demand. And with that, I will turn it over to Zach to kick us off today. Zach, what you got for us?
All right, thank you for that, Julia. And thank you for tuning in to this month's State of Freight. Craig, we've got like 5 or 6 headlines over the last month, one being the big, beautiful bill. We always have tariffs to talk about, but we also have a railroad merger potentially going on as well that we need to just get into. I think the best way to do this is just start off with kind of some high level setting with the freight market itself.
Can you believe that it's July? But you also think about the Liberation Day tariffs that were on
in 2020.
It was a quarter ago.
Yeah.
Like it was April 2nd was Liberation Day.
Right.
We're in just July. It feels like years ago because so many things have happened between when that first started and now. But it also is flown by. What do they say? The days are long and the years are short.
Yeah.
When you're in prison, that's kind of what this feels like. It's like this is like torture of just this constant news flow, especially when what we do is deal with the news. But it has been an eventful year for sure.
Yeah, and this past month, I feel like we've had a lot going on. In the freight market itself, domestically speaking, I think it's comforting, and yet it's not at the same time a little bit when I read some of our data points. Like comforting in the sense that we actually have some consistency in the data points. Like when we're talking about all these headlines, we tend to get these very hyperbolic storylines that trigger emotional responses and things like that. And it's going to turn into this big thing. And then the net result isn't always quite as emotional or responsive.
I think the administration has backed off a lot of a lot of it has been noise and distraction. And it was interesting. I just had this conversation with a reporter talking about the earnings calls of some of the truckload carriers. And the reporter is not in the trucking industry, and he just wanted a perspective on sort of what my thought was. And he was talking about how some of the earnings calls, there's more optimism, and some of the analysts were sort of surprised. And I remembered that the last time we heard from a lot of these companies was April.
Yeah.
Like it was like the last weeks of April, second half of April. And if you remember, again, I'm going to remind everybody, we were still in tariff. That 145% on China was still enacted at that moment in time. And we didn't get relief until May.
Right.
And so the last time we heard from any of these public carriers was, in many ways, some real level of pessimism and caution about what would happen because of so much uncertainty. And I think we've largely learned that that things are okay. There are deals getting done. We had just overnight, there was a deal with Japan that is at least a framework for a deal. Not too long ago, a couple weeks ago, we had a China framework. Again, details are scant. There isn't a whole lot of stuff. But South Korea is currently in Washington negotiating a trade deal. There's a lot of activity. Europe has teased that they may get a deal. And I think the noise has really helped people move on in some ways. Certainly, if companies are facing tariffs, they're having to deal with it every day. But I think the broader public business confidence some of the confidence surveys are coming back.
Right.
I think because people are like, okay, I can deal with this. There was so much uncertainty around Liberation Day, and all of the noise. I mean, the Doge noise. We had Elon Musk in February, and look, I thought cutting parts of the government is absolutely needed. I think most people would agree with that. But I think the noise around it, the media hyping up the draconian expectations, and just the fact this is so politicized, I think really hurt a lot of business confidence and investment. We're past all that. And now we're in a situation where we kind of know what the playbook is. We have some level of predictability when it comes to tariffs. I mean, some.
I was going to say, I don't know that I'm super confident.
Look, I mean, there's going to be headlines.
Yeah.
But there is some at least predictability, we hope. And then perhaps more importantly is we've gotten some of the big policy decisions that have been teased, such like the bill, the big, beautiful bill. And I think all of that is positive to say, even in our media business, media and advertising is always the first to go in any market. So when the economy gets uncertain and companies get really nervous, they tend to do two things. So they pull back on discretionary spending. Advertising is always the easiest thing to pull back because you're just like, I can cut it and my business will continue on. We don't want you to do that, by the way. But we're starting to see some of the bigger programs. I think in the last week, we've seen some of the biggest media buys in, actually not just in FreightWaves, but across all of our brands. Some of the biggest media buys we've seen all year. And that, I think, is a sort of a suggestion that there is a level of confidence coming back into the economy. That probably means when we enter into the fourth quarter, we should be poised for a much better sort of environment, a business climate environment. But I think the big question right now is housing. Housing is an utter show right now. It is absolutely, absolutely abysmal. And even people that are in real estate who are not building homes, home builders are bad, but people in real estate are, I know somebody who's in real estate who has been a very successful, runs a large, tens of millions of dollars in residential housing, who's actually having significant financial issues right now because there's just no deals being done. And this is in Chattanooga. And that, I think, is having a big impact. In fact, when you look at the housing market, as much as 20% of the trucking industry is directly or indirectly tied to housing. You know this. You worked in the floor covering industry, in a logistics business. Think about all the things that drive housing or are driven by housing. I'm not talking about lumber, obviously. I'm talking about drywall, obviously. I'm even talking about when people move into a house that's new to them, what's the first thing they do? They change the carpet because it's gross. Let's just be honest. The old floor covering is nasty that you don't want to live with the people who used to live there, so you change that out. Am I wrong?
You're not wrong.
It's the first thing they do, right? You always change out the rugs or the carpet.
Not wrong.
And then you end up, a lot of people will put new furniture in a house, good excuse to go buy furniture.
The finishings.
Appliances tend to get done. And so there's so much of the housing market that drives the trucking market because the stuff that you're buying tends to be big and bulky. And so the trucking market in many ways is tied to the success of the housing industry. And because there isn't really a lot of activity in housing right now, largely due to interest rates. I think that is the primary reason housing is so restricted.
Interest rates and the fact that, a lot of people that bought at low, the delta in interest rates over a short period of time, people that locked in at 2.5% aren't trying to move out of their house at 6%.
Well, but even listings, home listings, people that perhaps are renting, that want to buy can't because they can't afford the housing payment due to the price appreciation combined with interest rates. And I think one of the things the administration has done, so we've talked about the tariffs create a lot of noise. There have been some interesting things. It was one of those that they're going to allow the agencies, the mortgage agencies are going to allow rent history to show up as part of your sort of credit, like basically applying rent, what you rent as part of that whole calculation piece. That is a positive development for housing. So if we can unlock the housing market, I actually think the second half could be pretty bullish, but I think nothing's going to be unlocked until we see interest rates come down.
Yeah, let's look at the OTVI chart, tender volume index. This is going to be the trucking tender volumes. This is not a total picture of overall freight demand by any means, but it is one that I think our audience pays attention to most closely. And I think we still continue to see, this has actually been a surprising thing coming out of July 4th. I know July is typically a softer month for the freight market, but Craig, I'd like to hear your take here. A lot of the erosion year over year from the truckload volume, we can explain away with intermodal, a lot of that being modal conversion from that transcontinental freight, especially since it's pull forward environment and tariffs. But there does appear to be some level of economic deterioration in the truckload market.
Demand deterioration is absolutely here.
Yeah.
And I think, it started, we've talked about this a few times, started around Valentine's Day, and you can actually see that in the chart where the significant drop, that canyon drop in February, sort of mid-February. Some of the other parts were some seasonality, some weather that happened in January. That's why you have that dip. You also had a couple holidays that happened in January now. But effectively, what you saw was a pretty sharp downturn around a lot of the government noise, I'll say. And what is happening in July is it's been pretty soft relative to what we've historically seen. And I think a lot of that I go back to, I think housing is the reason.
Yeah.
I think that, because remember, housing and construction are typically summer. This is what drives the summer season.
Yeah.
That and beverages, but like the summer season
Especially
is
in the northern
produce,
tier.
beverages, and housing, gardening and housing is driven, particularly in July, is a lot of that stuff is happening. And we're not seeing activity in the housing market, which I think is what we can explain. Because a lot of the other data that's out there, auto's soft, but it's been okay.
Yeah.
It's soft, and a lot of it's because the manufacturers were encouraged to go do EVs, and now are having to sort of retool their whole business around non-EVs. But really, it's housing. I think the story of this chart is.
I mean, we did see some inflation in some of the bigger items like furniture and appliances over the last couple of prints of CPI.
But nobody's buying them. That's the.
I mean, obviously they want to buy a house first, and then they get into this.
I mean, yes, you have higher.
But I was going to ask you, do you think that has?
Of course. I mean, look, if you sort of look at the Milton Friedman economic playbook, is that inflation is a function of monetary supply.
Sure.
More money is matching. But what we're seeing right now is we've had demand destruction largely due to some of the noise. And I truly believe what we're seeing in the month of July, the reason it's been so soft, is due to the incredibly soft housing market. And I don't think people realize how big the housing market is to trucking. It's as much as 20%.
Yeah, it's huge.
And it is a huge piece of it. And when housing's not doing well, then the trucking industry is not going to do well. And I think that's what we're seeing right now. And I would love to say that, we would see a rebound. I think one of the surprising things, I'll say, that maybe, or not maybe, but I've certainly gotten wrong, is I expected a pretty sharp surge of imports off the West Coast as freight was rolling sort of pre-stocked, and I thought we would have had a more robust July as that stuff sort of came in June and rallied. It's apparently not. I think what's happening is it's coming into the ports, it's put on intermodal, and it's sitting right now in distribution centers and networks. Now, eventually that freight will funnel through the economy. But the pre-build has not been very beneficial to the industry. And it's largely because a lot of those goods are maybe this should have been obvious, but a lot of it is fourth quarter holiday related goods, consumer discretionary holiday, stuff that goes into retail. And therefore it wasn't going to be a big driver of it anyways. And maybe that's obvious now in hindsight. But I truly think the July softness goes back.
I agree with you. I was kind of concerned about the inventory level at this point because we did have, if we want to pull up the IoTI here, I think looking at the data paints a better picture of what we're talking about with the pull forward activity. And some of this is a little bit of a make up for lost time inventory. So the way to read this chart, bookings of 20-foot equivalent units coming from all over the world into the United States in an index form. It is a directional indicator of import activity for containers, not bulk. You can see this year, you've got that Chinese New Year, Lunar New Year sine wave there at the beginning of the year. Then we have some noise in April.
And it's all Liberation in May.
Liberation
It really
Day.
shows up in May.
And then May, you see the drop off.
Yeah.
Because of the Chinese cost prohibitive tariffs on China.
145%. And we saw the rebound in that relief.
Exactly.
And a lot of companies, I think, tried to hit that window.
Yeah.
Because there was a period of time where it looked like it would roll out in August.
Right.
And that hasn't happened. And I think the fact that we have some deal resolved,
right,
the details are scant, for China means that, activity is sort of the fear factor that's was driving that peak is largely gone.
Yeah.
And I think we're at a level that looks sustainable. But the issue that I think would surprise the truckers is that peak that you see in bookings and that surge of activity has not translated into strong truckload volumes. And so I think we can expect perhaps a better fourth quarter, a better September and October because of the stuff that's sitting in warehouses that's not being moved. But we can also look at the rail volume. I mean, I don't know if you saw JB Hunt's earnings, but their domestic rail was actually pretty strong.
Yeah, I think they have great volume, but they have a pricing problem.
Well, it's because nobody can price premiums. Yeah. The interesting thing about JB Hunt is that the other players, Knight Swift, reported last night, their intermodal business is doing very poorly.
It's not great.
Martin has sold their intermodal business. JB Hunt is like the only major truckload operator. Of course they have. They know what you're about to get to. They have a floating price. They can't lose.
Right.
Whereas all the other guys have fixed prices and they're selling into it. JB Hunt's prices move. Of course, that's why they're profitable. They have the best business model of all, but they can't charge more than a truckload.
Right.
Their ceiling on that rate is entirely dictated by the truckload market, which is incredibly soft. That's why JB Hunt is a fantastic. If you really want a index, if you're trying to buy an ETF for domestic surface freight, and you want a basket of products that sort of represent the surface freight market, JB Hunt's the best play out there because you got the strong last mile, you have the over-the-road trucking, you've got intermodal, and you've got the brokerage business. It's the best business model of any of the sort of legacy truckload operators, and it in many ways isn't any even more a legacy truckload. It's still a legacy truckload operator, but it's the best business model of any of those folks in surface freight because it has such a diversity. And like I said, it's an indexing business because it's so well ran.
Yeah.
But its advantage isn't just the current management team that's doing, I think, a stand-up job. It's also the decades of history of a business model that just won't break.
Yeah, they've got a lot of hedging in their
amazing,
portfolio of
dude.
business.
The whole floating thing with the railroads. And you look at all these other intermodal operators, and they're just in absolute trouble.
Doesn't work as well.
And it's because JB Hunt just has all the advantages built into their business.
Well, let's pull up the O-Rail versus OTVI. This is the loaded container volume index. Now, I've talked about this every single month since January, I think, maybe even sooner than that. But this used to be a little bit more of a balance, like intermodal was up 10%, truckload's been down 10%. We've kind of shifted a downward layer. Some of this, of course, due to that window of lack of imports coming into the United States for about a month there. But we're recovering, and we're seeing intermodal volumes pick up. And the comps on intermodal, you see a 3% positive year-over-year growth here. The comps are actually getting tougher for intermodal, and yet it's still growing, and that's something to note. While truckload volumes, they're hovering in this 10 to 15% deterioration year-over-year window. Thoughts on how this manifests in the coming, the second half of the year?
One of the crazy things, and I don't know if you can show it, but one of the absolute most insane things is the OTVI data is equivalent to 2019 levels.
Yeah, it is.
That is absolutely epically insane how just bad this year has been in terms of economic trucking activity. Is in spite of all of the enthusiasms. Look, I was arguably the most bullish guy in America back in November, right? When it came to the freight recession. Rest in peace, dear freight recession. That has not played out. Let's just call it for what it is. I mean, look, we can come up with all the reasons of why that was defensible. At the end of the day, this has been a crummy year for volumes. And the fact that UPS, did you catch this? That UPS is laying off 20,000 delivery drivers?
Yeah.
Is a business that gave incredibly substantial concessions to the union members. The old memes that you could, why go to school, become a UPS driver, is even a Saturday Night Live skit about how much money they made. This is a business that's, I think, for the first time in history, has laid off union Teamster drivers or has offered buyouts for them. And it's just a state of freight, man.
Yeah, it's a tough environment because you're not getting enough pressure to increase rates. And I think rates have largely been, clearly losing money in a lot of situations.
A lot of companies are losing money.
Yeah.
I mean, regardless of what data set you lose,
Yeah.
you would use the banks, you lose what Atri publishes on carrier operating performance. Heartland again,
Yeah,
like, do we need to put it on a death watch at this point?
man. I mean, it's
Like
clearly
106 OR. Has there been a company that has struggled as much as Heartland has since 2023?
and it was clearly they bought some bad business.
They bought the
Yeah.
commoditized truckload business.
Yeah.
They bought CFI,
Right.
Transport America, and they bought these businesses that had business models that were based on a 1990s long haul business that is no longer there. I mean, look, the same thing has happened to the business that my dad was the founder of U.S. Express, and in the 90s, the greatest business model in trucking was that long haul team operation. CFI was north-south at Mexico to U.S. On I-35, and U.S. Express and Covenant were I-40 and I-20, and the long-haul business is just dead for those truckload operators, and unfortunately, Heartland just can't seem to get a handle on that, and that's why they have these back-to-back. And look, I pointed this out on X, and someone mentioned U.S. Express's challenges. Of course, it's been out of business for been a part of Knight Swift for more than 2 years. It struggled as well. It didn't properly transition.
That irregular
Covenant,
route.
on the other hand, has. I mean, remarkably, Covenant has diversified its business model away from the over-the-road trucking business. But if you're in the over-the-road trucking business, you're in deep trouble.
Well, I mean, we talked about intermodal kind of taking on that long haul freight. I've got a chart that illustrates that here. Knight Swift just came out with their earnings, and
and by the way, they did make significant improvements to U.S. Express down to a 97 OR.
I mean,
which is when U.S. Express was a
105
public company. Yeah. Well, when it was a public company before it sort of hit the skids, it was operating in the 94s to 97s. That was sort of what it did in its last couple of years before things really went off the skids. Knight Swift has really proven that it can bring it back to some level of sustainability. And I think, in fact, when you look at the Heartland earnings and you contrast the story at Heartland and look at the success that Knight Swift has had with what they've been able to perform with U.S. Express in this climate, I think you got to give the management team some credit.
For sure. But Knight Swift, of course, is a kind of a more regional operator in general.
It has a much more short haul. Now, but Heartland does. I mean, this is the crazy part about Heartland is its business model is much tighter. It is known as a historically tight operator.
Traditionally.
More like a Knight than and less like a Swift. But Knight Swift, because of Swift, does have a larger length of haul. U.S. Express historically is represented more of a long haul. It looks more like a Swift than it looks like a Knight. But I got to give credit to the management team. They've done a much better job of really turning around U.S. Express than I think they're getting a ton of credit because they bought that business when the market deteriorated. And I think they should get some credit for it.
Yeah.
And I'm saying this as someone who has a personal, a personal story tied to the success of that business.
Yeah, for sure. And the chart that I wanted to show everybody was the long haul freight versus short haul freight. So we've got the COTVI in white that you're looking at. That's going to be load tenders for less than 100 miles. So city freight, mostly minimums. And then you have the LOTVI there, which it's not reflected in this chart clearly, but LOTVI down 27% year over year.
What's that long haul freight, man?
It's anything over 800 miles. But the thing that I'm not showing you is that LOTVI, for the first time since we created this, has dropped below COTVI now twice this year.
Wow.
In total, meaning that there is more short haul freight in the less than 100 miles.
But this was a long-term trend.
Yeah.
And I think this is a trend that is continuing to take place. But here's the interesting things. If Donald Trump's policies are successful at reindustrializing the economy, regardless of we tend to talk about politics a lot of times, but I'm not here to make a statement on whether his policies will be successful or not. If he is successful in reinvigorating the manufacturing sector, then the long haul market could and should increase. But as long as you're dependent upon import activity, then a lot of that import activity is going to be containerized and is going to go on the railroads. You mentioned it, you teased it early on. Let's talk a little bit about some railroad mergers, man.
Yeah, oh yeah. Well, one thing I want to say to tie up what you were just talking about with the railroads, because I was talking to Mike Bowdendistel about one component that's kind of compounding this. We're almost in this like perfect intermodal world right now.
Enough volume to sustain.
There is, well, also one of the things he read or put out there was that the larger ports have actually benefited from this pull forward because most of the volume has gone into the larger ports, taking share back, which is where all the intermodal hubs are.
Yeah.
But yes, the potential railroad merger that we have to address here, of course, being Union Pacific and Norfolk Southern,
could be BNSF and CSX.
That's been rumored, but Buffett denied that they had anybody reach
Buffett
out.
denied he hired Goldman Sachs.
Okay.
And if you think about it, this was an interesting thing. I went down this long journey of reading a bunch of stuff. And I can't remember who commented on it, but if you're Warren Buffett, you don't need a banker to evaluate.
No, you don't.
like arguably, and I apologize if anybody works for Goldman Sachs is listening to this. Actually, I don't apologize. It's true. If it's Berkshire Hathaway, they have such an amazing track record of evaluating businesses, and they know the railroads. Yeah. They do not need Goldman Sachs' help.
No.
They can do it themselves. And so the rumor basically that got denied was that they didn't hire Goldman Sachs. It wasn't that they haven't been evaluating it. Okay. It's that they haven't hired.
It makes too much
sense.
sense.
It was a very I think the response was very carefully worded. But when you actually looked at it, you don't need Goldman Sachs.
Sure.
But it makes absolute sense.
Yeah.
I mean, look, if I could come back in a second life and run a railroad, it's a dream business. By the way, I'm writing a book. It's going to be out in October. And one of the lines in there that I found astounding is that the railroads, Union Pacific, made more money in profit than Microsoft did 3 years ago. Higher profit, like imagine that.
And they get criticized when they drop their ORs into the 60s.
Oh my God, these are amazing business models. And the consolidation ends up just making them that much more profitable. Someone asked, is this going to be good for shippers or bad for shippers? And I would argue that rarely does a railroad merger benefit the shippers. Now, there is the argument, let me make the counter argument, this could actually be different because if you're able to get transcontinental freight, which I think does happen within 5 to 10 years, and maybe even sooner, if you're able to go from LA to Newark without stopping in Chicago and transferring lines, it could be a pretty astounding competition to the trucking business.
Sure.
Who loses? You know who loses in that? It's the owner-operators and it's the brokerages.
Yeah.
Who wins? JB Hunt. That's who wins. It's the hub groups, it's the Hunts, it's the large shippers win if they can get that intermodal. I think it's the intermodal business wins. I think the traditional railroad shipper, the big commodity players, the coal, the grains, the oil, all that, they probably lose.
Yeah.
Because the service quality will likely deteriorate for those commodities, but should improve for intermodal. Amazon wins, FedEx wins, UPS wins. Anybody using that intermodal.
Do you think they win more from a service perspective or a pricing perspective?
No, I think but you could argue both. Let me argue, like I have said that I don't think consolidation necessarily is a good thing generally for the whole market, but I do think there's going to be winners and losers in this. I think what ends up happening is the railroads do gain pricing power. Amazing, they're going to print more money. Like we should all own a railroad and be so lucky.
Wow.
I remember when Berkshire Hathaway, when Warren Buffett bought the BNSF, and a lot of people criticized it because they said, well, the autonomous trucks is all going to go away. There was like a whole narrative about trucking going away. And his statement was, railroads are going to be around 50 years. This is a business that is, has a natural moat. I do think pricing will go up. But the pricing, as we've learned just talking today, is there's a ceiling on what a railroad can charge for its services when it's competing against trucking.
Right.
But if you can take a rail container from Los Angeles and transferred all the way to Newark without stopping in Chicago, then that's a huge win. Who also loses? Chicago.
Yeah, Chicago.
Chicago loses.
Chicago is also kind of already this congested mess.
Chicago loses, and I think it's going to be a loss for some of the. Now, maybe freight that originates in Chicago won't lose as much, but they certainly will lose some of the volume that they're handling.
Well, explain why that Chicago would lose in that. If people aren't necessarily familiar, that Chicago is kind of this.
Chicago is the one city, I think all 7 of the Class 1 railroads go into Chicago. And it is unique in the sense that it does that because Class 1 railroads are really these are the big players, right? And so Chicago happens to have all the major railheads, and it's like if there was one airport in the United States that handled everything, Chicago O'Hare, you could argue Atlanta for us in the South, but like even more concentrated is Chicago happens to be like the mega hub for rail freight going north, south, east, west. It just all goes into Chicago. And it's just perfectly positioned as a city for that. It will end up losing some of some of the volume. And perhaps even some of if you're bypassing it, you're not bringing trains in and out. Now, it may mitigate some of the congestion problems. It should, arguably, if there's less traffic. But I think this is an enormously interesting development. And look, it won't stop. And if the STB, we actually, John Paul Hampstead had the chance to interview the Service Transportation Board chair, STB chair, on Bring It Home. This was a couple of weeks ago. You should check out that podcast, Bring It Home. By the way, you can find it on YouTube, and you're looking specifically for the STB chair interview. He talked about this, and he talked about—
It was in June, wasn't it?
It was in June, and he talked about quick answers are better than— basically his summary and what you got from that was he wanted quick answers. And I think one thing about this administration is that when things are big, and they seem to like the railroads, Donald Trump seems to really be fascinated. He is anybody who's ever built something as an architect and who's like a builder loves the railroads. There's something great about that. And I suspect he'll be very supportive of this kind of merger. It will create more pricing power, and I think it won't stop with just NS and UP. It probably ends up with a CSX merger as well. And then now we have transcontinental railroads.
2 of them.
We'll have 2 of them. I mean, if UP does something, being it's the old FedEx, UPS, Coke, Pepsi thing. When one does something, the other one does it.
Right.
And I suspect that when it gets to all of the antitrust review that would inevitably happen, STB stuff that inevitably will happen, you will hear, interesting enough, that BNSF will be very supportive of a consolidation because they can't come out against it if they have their own merger planned.
Right. No, I mean, they'll have to. Like, that actually would be if they're going to allow that one,
you got to allow
the
but
other.
if they come out against it, then there's and it probably ends up going anyways.
Right.
But there's no hope for them if they're going to come out against it, because then they get to be called hypocrites. So it is, I think one of the most exciting things happening in freight is that if you sort of back up a couple of years ago in sort of that pre-COVID level, we had a lot of all these new technology vendors were coming in here, this poor venture capital. We're seeing a lot of deal activity of technology businesses. DAT has been very active in the market. Triumph has been active in the market. You're seeing a lot of consolidation happen in technology. And there's just a lot of deal flow happening, which I think is exciting because it just means there's stuff. There's stuff that's happening. And then sort of the next generation is we have AI and freight tech coming in from AI. There's all these AI platforms happening. This has to be, put the charts aside, it has to be one of the most exciting stories just exciting times in freight if you work in this industry with all of the stuff happening that's sort of getting us ready for the next generation of it.
Yeah, so what are you most excited about?
I mean, I'm just excited to get back to. I want these rejection levels to go up. Let's pull up OTRI because,
we haven't talked about OTRI, which is probably the most important one to talk about.
Please look at this thing, and we showed how abysmal volumes are.
Yeah,
but look at OTRI, man. It is, in spite of the slowdown that we had in volume that we just described.
Yeah.
The fact that we're at 2019 levels. We're still, at 5.5% in terms of
We're
rejection
still beating
levels.
last year.
We're beating last year, and I think you should look at that as a real positive development. I think that is a really good sign for next year.
I mean, I want to hear if you, I mean, I think you agree with this largely in the way that tender rejections do something that rates can't do. It tells you kind of like we're kind of forced into these binary, categorizations of things are either good or they're bad. I think tender data or the tender rejection index tells us there's actually layers of good and bad, and we have been pushing up through bad layers from a transportation service provider perspective for a few years now, and the fact that we just survived a 16% demand collapse with
with 5.5%, but it's because so much capacity has been removed from the industry.
Yeah.
And I think you have to go look at where did that capacity come from? We've talked about it extensively. It's been a flood of the market of new participants, of new trucking companies, and truck drivers. This whole idea of a driver shortage, and I've been pretty critical about the ATA's position on the perpetual driver shortage, just doesn't exist. It's because we've had so many new participants come in the market. This ELP mandate, which this English proficiency mandate that the administration has passed, is, I think, having a fractional impact on capacity. Mm-hmm. I don't think we've seen a washout, but I think we're going to continue to see, as we see more enforcement. If housing comes back and energy demand comes back to a degree, when we start to see some of the real sort of acceleration in some of the other parts of the economy, it very well could be that we see more labor leave the trucking industry and more tightening capacity.
Yeah, let's pull up the CDNR, the carrier details net revocations. This is not exactly the way that I traditionally look at the change in operating authorities and FMCSA data, but I think that this is still an ongoing thing that we really need to pay attention to this side of it, because we have additions as well as revocations. This focuses on the revocations, and the acceleration in revocations this year, that is literally just operators leaving the market either due to inactivity or self-reported. And
that's a beautiful chart, by the way. Look at that thing. Look at this pop from October, really November. Now, some of that very well could be, I mean, the freight has been soft. Some of that very well could be the Drug and Alcohol Clearinghouse effectiveness. This most recent surge is really interesting.
The 1,900 in the last week. Now, there could be some administrative.
Now, you also have July
stuff,
4th and
exactly.
stuff. But that is an interesting chart right there, Zach.
The fact that we are outpacing, I mean, again, weekly is not necessarily the best way to look at revocations, but I threw average lines on here just to show you perspective on how this is not a traditional way.
How fast does this data get updated?
Every week.
So what does it take let's talk a little bit about, what does it take to revocate?
So it takes 12 months of no activity, 0 miles, or you don't update your authority. And that's basically
so it's a lagging indicator.
Yeah, it's very lagging.
Yeah.
So this is the end result of probably a few years of struggling. Mm-hmm. And there's probably a lot of inactive operators out there right now that aren't getting into this data set.
Yeah.
And I think the fact that we are sustaining an acceleration of revocations is a very telling indicator, regardless of the new additions, which are kind of leveling this out a little bit. This tells me at least that this market is still extremely challenging for a lot of carriers. You talked about the end of a freight recession, but that doesn't mean things are automatically awesome.
Well, but first of all, we're still in the freight recession, and I think I talked about the end of it.
Yeah.
If you sort of look at whether conditions are good, they're not.
Right.
And I think we have to be judicious. I have to be honest that call was incorrect. Like, it was premature. We got overly excited, exuberant, for a lot of sort of reasons that there was a lot of data to support it, but it turned out to be a nothing burger, if we were to be completely frank. Is like we haven't seen a rebound in the market, and we've seen volumes really deteriorate. I think on the counterpart of that is that there's been so much deterioration in capacity that the market has held up pretty strong in spite of very soft volumes. And I think if we can get some push, if we can have lower interest rates by the Fed, and we can restore some semblance to the housing market to sort of drive activity, because there's demand there for housing. Like, there is still millions of people who would like to buy a home that can't.
Sure.
If we start to see interest rates come down, and we start to see some level of sort of activity in the housing market, that's what will carry the second part of 2025.
Do you think it's going to take a interest rate cut?
I think you have to, and I think the Fed is overly restrictive, and the Fed has stayed largely restricted because of the fear of tariff inflation, or inflation caused by tariffs, which I think judiciously we don't see.
Right.
Like, there has been the fear, and they have said, I think Powell has said, that inflation could come because of tariffs, some of the trade policy stuff and policy decisions. It hasn't played out that way. Now, in fairness to those that have hated and detracted against tariffs, what we have likely seen is demand destruction. Demand destruction is absolutely in the data, caused by tariff noise.
Right.
But in terms of actually creating economic-wide inflation, the data doesn't support that. Right. Energy prices are lower, food prices are lower, housing prices continue to come down. And so what we've seen is demand destruction. And look at I don't know if you saw the PMI data today. The PMI survey data, services actually shot up, something like 55, which is an expansion area. It's like
right.
It beat, whereas manufacturing contracted, which I thought was really interesting. It was
Yeah, well, I like, because part of the tariffs is supposed to be, and I don't think anybody expects this to happen immediately, but part of the tariff's purpose is to reinvigorate the manufacturing.
Yeah, but it's not doing that.
Yeah.
And I think it's because a lot of the goods, services are one of these interesting things. If I don't have certainty of where the economy is headed, I can make discretionary spending that is in services, because I can pull back if things do it. If I end up making big purchases of goods, I'm kind of stuck with those goods. Whereas in services, it's a little different. I can take the extra trip, the extra vacation.
Right.
I can afford to take the vacation. Whereas when you're dealing with like goods, if I go buy a new car, I'm stuck with that thing for
an investment.
6 years. Yeah, and so buying even a new washing machine, or like, I'm not going to make these big ticket purchases. And I think so services are in many ways rebounding, or have actually been pretty robust. Hopefully we'll pull the manufacturing sector out.
So we didn't even get through most of the stuff. I want to make sure we leave time for questions, but I have to follow up what you're talking about right here with the big, beautiful bill. I think a lot of people feel, especially in the financial space, feel like this is going to be a large stimulating bill for the most part, because of the capital expenditures and the increased investment potential here.
It's amazing.
Like,
let's get bullish for a minute.
Well, yeah, let's hear it.
I'll tell you why I think the big, beautiful bill is beautiful. Okay, look, driving more government spending is not positive long term, and let's put the deficit aside. But we're freight people. We care about the amount of freight moving through the economy.
Right.
What does is in that bill is a couple of really important points. One is you have things like substantial tax cuts for investments in manufacturing, in physical capital expenditures. You have bonus depreciation that is permanent. This is perhaps one of the underappreciated things. Is typically bonus depreciation is put in by Congress that starts off to stimulate and then draws down. And what is happening with bonus depreciation is this relatively permanent fixture to it, where we'll have it for at least 5 years,
2030
to 2030, where it's 100%. So you don't have the stair-stepping problem. You get it for the next 5 years, a sort of semi-permanent. It's not permanent indefinitely, but it's permanent in the sense that it's a couple years. And so what you end up getting is, and I think what will end up happening is that Congress will extend it. Like, I just think that's what happens.
Well, they get addicted. We get addicted.
And look, it's good, because it means that companies will go spend money on capital, big CapEx, which does drive the manufacturing sector. And so I think it's incredibly positive for it. I think also things like, does the no tax on tips and over time, I don't know. I mean, to some people that's important, but there's a lot of these.
It feels a little gimmicky to me.
It is a little gimmicky. I think that's fair, and it's also, if you read between the lines, it's not as good as what it was advertised. But there's a lot of reasons to be bullish on some of the stimulus. I think these trade deals creating some stability, some investment. And look, I think the fact that we just had one of the most prolific military exercises in the Middle East that we've had in decades, that we got in and got out. And I think what we're also seeing is that the fact that a lot of Iran and its sort of supporting terrorist groups and groups that were causing a lot of havoc in the Middle East have largely been decimated, or at least are not. They don't have the ability to inflict the kind of pain, and yet we don't have this protracted war that we're all now involved in. I think there's a little bit of relief in that too.
For sure.
That there's some optimism to look forward to, because a lot of this stuff was a lot of noise. I mean, we in the second quarter had, Israel's been dealing with this for a couple of years, but certainly the threat of Iran. We had the Liberation Day tariffs. There's a lot of news.
Yeah.
And I think people just want to move on and get back to doing business.
They just want to do their jobs. So let's get back to answering your questions. Let's open it up for a little bit of Q&A here. We got about 13, 14 minutes left. Julia?
Awesome. Yeah, I've got some great questions already. For those of you who haven't submitted yours, go ahead and enter it in, and I'm going to go ahead and kick it off. This first question is from Blair, who asks, what's your outlook for fleet truck purchases for the rest of the year?
I think fleet truck purchases are struggling, and they're going to continue to struggle. I mean, you've seen some layoffs. One of the OEMs, and I want to say it's Volvo, but I don't think that's right, actually had a pretty significant layoff this past, a couple weeks ago. So you're going to see truck purchases are going to be soft. Truck purchases follow. They're a lagging indicator. They're not a leading indicator. Some people get this wrong, and I see people talk on X a lot about how truck purchases are a leading indicator. And maybe they are for the broader economy, because the broader economy is so lagged to the freight market. The fact is that the truck demand, OEM demand, is correlated to freight health, the freight market's health. And until we see the conditions change, it's going to be a difficult, challenging. So if I'm in the truck business, or I'm perhaps buying stocks and OEM stock, I'm looking at the indicators that we talk about here. I'm looking at OTVI, I'm looking at spot rates, I'm looking at volume, and I'm trying to understand what is the health of the freight market, because that should give me some indications of what to expect of the truck market.
Yeah, I'm definitely bearish in the near term until we see some sort of demand side inflection. But the data is showing us that this is a market poised. Still, we've been talking about that for like 7-8 months. We just haven't had that sustainable flip, and that obviously will lead to increased orders. And I think that may happen fast when it does turn. Now, I don't know when that's going to be specifically.
You think the OEMs come in force? I don't agree with you.
No, I'm saying the market will flip.
Oh, I think the market could.
Yeah.
I do not think that there's a sudden surge in truck orders.
It would be hard, because as somebody who used to also kind of evaluate whether or not you should purchase a vehicle or a truck, a Class 8 truck, that takes so long. That takes months to kind of plan into your budgets and your CapEx. I don't know about the big beautiful
I don't think
bill.
there's any. I don't. Well, that's a good point. That is actually.
There's some.
It's a good counter argument.
Yeah.
That you could see bonus depreciation drive, but the difference
But you got
between
5 years to do that.
The difference. That's exactly it. The difference is with this particular set of bonus depreciation is it doesn't expire.
Right.
The 100% doesn't expire, so the need to do it earlier just doesn't. You're going to get it next year. Now, this is a year that hasn't had great earnings. Right. A lot of the trucking companies don't have great earnings, and so they don't have a lot of income to protect or offset.
Swift is down 1,500 active drivers.
So I don't think, I think now that we sort of play this conversation out, I don't think that the big beautiful bill or bonus depreciation is going to be a factor until we see better earnings, because they're going to, if you're going to offset, you want to have a lot to offset. And right now they don't have a lot to offset.
And they've been down for 3 years now, so there's just not a lot of cash reserve left.
Yeah.
Question here is from Michael, who asks, what current data trends are showing in the new Sonar Trade War Command Center?
Oh, this is a fantastic question.
This is one of the things I didn't get to. So we can pull it up. You know, the big ones that stand out to me in this, of course, you can, you know, see the.
Look at China. I mean, what's interesting is, and this is, you can see this in the right quadrant on your screen, is look at how if you looked at this a month ago, you could actually, if you clicked on China, Zach, you could actually see this in the data, is that you saw this massive surge of activity and this cooling off, but just the fact that a lot of these China and Chinese dependent countries, adjacent countries, are starting to see significant slowdown, I think is a sign that the trade war pre-stocking is over with. Let's go back to where we were before. I want to go back and check another thing. Is like, I mean, Vietnam is starting to get tired. Thailand, who's been the big winner, is starting to get tired. You do see some of the European countries have done okay.
Brazil, who of course was in the headlines for a hot minute,
Yeah.
got a little bit of a boost. But I do think it's important to look at these changing trade lanes.
And you could even do regional trade analysis. One of the new features inside of the, up there, right there, is the different countries that we now have in here. And you can see how different regions of the world sort of respond to
Europe, we've got the Middle East now in there active. The internet.
I think your Wi-Fi connection.
Yeah, my Wi-Fi is not great. I'm trying to do too much with my computer. There it is. But yeah, you can focus on all the major trade lanes.
What I think is interesting is that Europe, we don't have a tariff deal with Europe yet, although there has been something teased that we may be getting close to that.
They were expecting, I think they said that the Japan deal kind of sets the framework potentially
15%.
for 15%.
Because these, you know, Japan's arguably one of the U.S.'s closest allies.
Yeah.
It's also very security dependent upon U.S.
That's one of the,
security.
To me, that was one of the bigger kind of deals that made.
This morning, I was listening to CNBC, and they were saying that it's no longer 10% is the floor, 15% is the floor.
Yeah.
I mean, Japan is a country that is such a close ally to the United States that, but it's also security dependent upon the U.S. And in some ways economically dependent, or in many ways economically dependent. It's interesting because they don't have a ton of, they have some leverage over the U.S., but a lot of it is still, they can't be in a contentious relationship.
Right.
So I was reading some of the noise that was coming out with some stories that Japan was going to unite with China.
Right.
Whoever wrote that story does not know much about Asian history.
Oh my God.
Or understands Japan's view of China, and in many ways China's view of Japan. I would read that and I'm like, I just don't think that's valid.
You visited Japan numerous times.
Well, but I also studied a lot about Asian
yeah.
history. And like, if you know anything about the Japanese and the Chinese, is there's no love lost. Now they'll do business, they're merchants, but they're not going to,
culturally,
they're disaligned. And Japan is absolutely terrified of an ascending China.
Yeah.
And so it's just interesting because that's sort of a backdrop of it. But you're right. I think the Japan framework is really a better indicator for what we may see in some of these trade deals and likely to see in the European trade deal. And Europe is very, very dependent upon the United States from a trade standpoint, much more so than we are.
Yeah, for sure.
Europe doesn't produce much anymore.
Just like we.
Well, even less so.
Yeah.
I mean, they've decommissioned a lot of their energy, which has really hurt them.
Everybody's been using Asia.
Great. My next question here is from Laura, who asks, what are your thoughts on rail theft and what are the railroads doing to circumvent theft?
Railroads are doing some interesting things. You know, it's hard because these are essentially rolling warehouses that have big targets. I was going to say on their back, but I guess you could use that but they have huge targets. Where they tend to have problems is when the trains are slow in the big cities and the urban areas is where they tend to be most exposed. You see these videos of people breaking into these containers and opening up and these Amazon Prime boxes all across the field. You know, they're putting things with security cameras. They're doing a much better job of trying to police it. They've invested a lot in security details. I mean, one of the things people don't realize is that the railroads have their own, effectively, federal marshals. Yeah. They have the ability to have their own police forces that do it. But they've invested a lot in technology, a lot of in AI. Again, bring it home. I recommend the podcast only because it's we had the chance to talk to the Union Pacific CTO. JP and I did. This was 4 or 5 months ago. About what they're doing around technology, and he had some really interesting things to talk about on fraud and data security.
Yeah, and the rails have the cash surplus to invest.
They
in
absolutely do, and I think they had spent something like $2 billion on some of their technology investments just this year, including security.
Yeah,
so.
I mean, and I think this is also a little bit of a byproduct of the environment we're in with this pull forward, having so much time for a lot of this freight domestically.
The railroads have some advantages in some ways in security over the brokerage truckers because they know who the counter. The advantage I have on a train is that as long as the freight's moving, then it is. I have possession of that container, right? It's when you end up in the urban areas where you tend to have problems, but you don't have the fraud issues that propagate through traditional trucking and particularly brokerage that really are I think are much more problematic.
I just got an image of like an old Western with somebody robbing a train.
Oh yeah,
when you said that.
Well, but there's nobody to hold up. It's great.
Yeah, and it's only when it stops in a yard or something like that. And we just talked about how there's so much more of it.
Well, I think that's one of the advantages of moving, outside and having transcontinental. I think you have to be bullish on the railroads.
Yeah.
I think we got to gush on the railroads.
I would moderate that, even though I am overall bullish. I would moderate that a little bit as the tariffs and the trade war kind of settles down.
Short term.
Yeah.
Short term. Yeah. But I do think the advantage is that it's a cheaper form of transportation.
Sure.
It is a moving warehouse, and as supply chains are not as strained through JIT as much as they have been, I think it benefits. I think they have gotten their act together in a modal way. The amount of freight that the ports have been handling over the last 18 months, we don't give the ports and the railroads enough credit for the amount of volume and not having the COVID-style crumbling that happened to them.
Now, the difference here is that the sense of urgency is
sense of urgency is there. You have chassis in the right location.
Yeah.
You have access to containers. You don't have staffing shortages. But I don't think we've given enough shout out to the infrastructure. And these are largely union folks, whether it's the longshoremen. We got to interview, what was his name, the longshoreman?
Oh, wow, yeah. Last year he was the
I need
story of
him
the
at
year.
an F3. By the way, F3 is coming up.
Yeah.
Do a shout out, F3 in October in Chattanooga. We're actually doing it, thank you for the production team, totally teed this up.
Yeah.
But it's at the Chattanooga Choo-Choo, speaking of trains.
Yep.
We're hosting at the Chattanooga Choo-Choo. We're not in a convention center, it's a little different. What's great about it is we're not using convention food this year, so you show up, you get a gift card. There are 40 restaurants around the Chattanooga Choo-Choo. This is a much more South by Southwest festival feel. It's at the Chattanooga Choo-Choo, and I think it's just going to be incredible.
That area,
be great.
Anybody that was at F3 a few years ago, we were in that area.
We were.
Yeah.
But this is going to be right in the middle of the Chattanooga Choo-Choo, F3. It's going to happen. We're excited. It's also, just to be clear, this is in mid-October.
Yep.
Which is an amazing time of the year.
Perfect
The weather
weather.
is absolutely perfect. The leaves are starting to change. Yeah. You can't imagine I think F3 is going to be epic. Now, we also, before we go, I want to do one more shout out. For those that are interested in AI and supply chain, the AI, dude, our production team is absolutely on it. I'm not even by the way, no one's telling me to say these things. Yeah. They are just so good at it.
They're ready.
This is the AI, usually Julia does this thing, but the AI Summit, if you are in supply chain and you're interested at the intersection of AI, you should be there. This is held at the International Spy Museum. What is a better place to hold AI event than this? All about supply chain in Washington, D.C. That is next Wednesday, July 30th. I know, it's crazy, right? Yeah. But it's all about AI and supply chain. And AI is going to be transformative as a piece of technology. Supply chain is absolutely front and center to that. So we have two big events coming up.
Yeah.
We have F3 and AI, and you can actually get bundled tickets. You can buy and get to both when you come see us.
Bring the family.
Yeah.
Both are in a good spot for that.
And this is such a crazy time.
Crazy. Understatement.
Awesome. Well, looks like that's all the time we have for today. As always, thank you guys for joining us, for asking such great questions in the audience. Hate that we didn't have time to get through all of them, but we love to see them coming through. Craig and Zach, as always, thanks for sharing your insights with us. Head on over to live.freightwaves.com to learn more about F3, the Future of Freight Festival, and be sure to join us again for next month's State of Freight on August 21st at 2 p.m. Eastern. Thanks, everyone.